Your bank is quietly taking money from you every single month. And the worst part? You gave them permission to do it. Not through scams, not through errors, through perfectly legal systems built directly into the credit cards, loans, and everyday banking products that millions of working Americans use without ever questioning how the charges actually work. Here's why this matters. Most people spend years focused on earning more money while completely ignoring the financial mechanisms that are silently reducing their take-home income month after month, automatically, in the background, without a single notification. So before we talk about saving, investing, or building any kind of financial cushion, you need to understand exactly where this money drain begins, and more importantly, why it almost never stops on its own. Most people assume money leaves their account for obvious reasons, things they consciously chose to pay for. Rent is expected, utilities are predictable, loan payments feel intentional because they show up on a clear monthly schedule. But modern banking doesn't rely only on large, visible transactions, without interruption. Interest accumulates daily. Minimum payments reset balances instead of eliminating them. Service structures extend repayment timelines without requiring a single additional action from the account holder. And because these charges are broken into smaller, recurring amounts, they almost never trigger alarm. $10 here, $20 there, a small percentage added silently to an outstanding balance. None of it feels urgent in isolation. The account works, payments go through, nothing looks broken. But over time, these recurring mechanisms reshape financial outcomes in ways most people never stop to calculate. Debt lasts longer than expected. Total repayment grows well beyond the original amount borrowed. And even as income increases, available cash flow often feels completely unchanged. This creates a deeply confusing pattern for working adults across the country. They're earning more than they were a few years ago, yet financial pressure feels almost identical. The issue isn't always spending behavior. More often, it's the ongoing cost structure quietly attached to financial products people already use every single day. To understand why this happens, we need to look at how these monthly banking charges are actually created and why they keep running long after the original decision was made. To understand why these charges never stop, you have to look at how modern banking products are actually built. Most financial services aren't designed around one-time payments. They're engineered around ongoing participation. Credit cards, personal loans, auto financing, and even basic checking accounts run on models where cost is distributed across time rather than presented clearly up front. Take credit cards. Interest isn't added once a month as a flat penalty. It's calculated continuously against your remaining balance. When you make only the minimum payment, the majority of that payment typically goes toward interest first, while the original balance drops at a fraction of the pace you'd expect. From your perspective, the payment feels responsible. From the system's perspective, the account stays active and profitable. Automatic payments reinforce this cycle. Autopay prevents missed deadlines, which sounds helpful and often is, but it also removes friction. When payments happen automatically, people stop reviewing statements closely. Charges shift from conscious decisions to invisible background noise. Fees follow the same pattern. Maintenance fees, overdraft structures, balance transfer terms, late payment margins, all typically disclosed during sign-up, but buried across lengthy agreements that almost no one reads in full. Once activated, these costs quietly integrate into normal account activity. None of this requires deception. The system doesn't work through surprise. It works through consistency. Small, recurring costs continue because nothing ever interrupts them. As long as accounts stay open and balances exist, the process runs in the background indefinitely. And this is where the real damage begins, because over months and years, these mechanisms don't just drain money, they extend financial timelines, stretching obligations far longer than most people ever originally expected. The reason these monthly charges are so damaging isn't because any single fee is catastrophic on its own. The real impact is what they do to financial momentum over time. Most working adults recognize this pattern even if they've never named it. Income gradually increases through raises or career changes, yet financial breathing room never improves at the same pace. Expenses feel manageable, payments are being made on time, nothing looks severely wrong, but real progress still feels painfully slow. Recurring banking costs are a major reason for that disconnect. When interest continuously absorbs a portion of every payment, debt repayment stretches across years instead of months. When balances stay active longer, additional interest keeps accumulating. And because these costs are woven into normal financial behavior, they almost never trigger the kind of alarm that would prompt a change. This is what economists sometimes call a stability illusion. Accounts stay current, credit scores hold steady, bills get paid. From the outside, everything looks financially healthy, but internally, cash flow stays permanently restricted. Money that could be moving towards savings, investments, or an emergency fund is instead being redirected, month after month, toward maintaining existing financial obligations. Over time, this quietly eliminates flexibility. It makes unexpected expenses feel disproportionately stressful and makes long-term goals feel perpetually out of reach, even for people with steady, reliable incomes. The outcome isn't financial collapse, it's financial stagnation. And stagnation is the hardest kind of financial problem to recognize because it doesn't feel like failure. It just feels like working constantly without ever meaningfully getting ahead. Understanding why most people never question these systems in the first place is the key to finally breaking the pattern. At this point, the most important thing to understand is this. Monthly banking charges aren't inherently abnormal. What matters is whether those charges are actually reducing your financial obligations or simply maintaining them indefinitely. The first step is identifying exactly where your money is going each month beyond fixed living expenses. Pull up your most recent bank or credit card statement and look specifically at interest charges, service fees, and recurring account-related payments. These are the places money quietly disappears without creating any forward progress. Next, calculate what percentage of each payment is actually reducing your balance versus going toward interest. Most people are surprised to discover that a large portion of what they pay monthly isn't meaningfully lowering their debt. Increasing payments, even slightly above the minimum, changes the rate at which balances decline and significantly reduces long-term cost. Autopay should be a tool, not a replacement for oversight. Keeping automatic payments active while still reviewing your accounts regularly ensures your spending stays controlled rather than invisible. Finally, eliminate or renegotiate any recurring cost that no longer serves a clear purpose. Financial systems will continue running exactly as structured, meaning unused services and extended debt will persist until you actively intervene and change them. Banks charge based on existing agreements. When account activity is consistently reviewed and adjusted, those same systems stop extending debt timelines and start working in your favor instead. Understanding where your monthly charges are actually going and confirming that every payment creates real, measurable progress is how you transform ordinary banking transactions from a passive, ongoing cost into an active form of financial control.